But what about the long-term and the medium-term outlook on the market? That's something we'll discuss with Trideep Bhattacharya. He's the President and CIO of Equities at Edelweiss AMC. Hi, Trideep. Good to be speaking with you. While we're at the end of 2024, I think at the start we wouldn't have imagined that this is how the year is going to pan out. But any crystal ball gazing for 2025? What kind of return expectations? Which class of equities will do the best?
Good afternoon. Thanks for having me on your show. I would say that, we talked about beginning of 2024 that this will be the year of elections and full of volatility and a lot of changes in and around policies and, incumbents. And it turned out to be that way. I think 2025 will see the flare of the policies of, new governments actually coming to fore. Most importantly, particularly in the United States, I think on Jan 20th, as you see, Trump taking over, Mr. Donald Trump taking over, you would see a meaningful, update with regards to their policies and the markets reacting to the same. So that remains an unknown, I would say, on the face of the markets. But I think if I take a step back and look at earnings, which ultimately is a driver for markets over the medium term, I would say that in the first 6 months of this fiscal year, we have seen hit an earnings pause. We've seen an earnings downgrade of about 6 or 7%, which we haven't seen in the last almost 2 to 3 years. And that's worth noting. The reason why that happened is because obviously government decision-making stalled. Weather played a bit of a truant, too much rains and too little rains in one quarter and the other. And a lot of auspicious days kind of oriented towards the second half of this year. I think that is what is due to change in the next 6 to 9 months, and I feel positive about. So I think as compared to where we are standing, while the recovery will be gradual, I do see earnings recovery happening over the next 6 to 9 months within some sectors more than others, but generally earnings recovery happening. And that is good news for markets over the next 6 to 9 months perspective.
So what is the kind of earnings recovery that you're expecting in the second half, and what is the kind of earnings growth that you're expecting for FY26 as well? And given the fact that you're expecting an earnings recovery, which will be a good news for the markets, which are those sectors where the recovery could be the highest?
Yeah. So I think the first thing to note is this year, FY25, earnings growth in aggregate for Nifty 50 or otherwise would be in mid-single digits. So most likely, as by the time we end FY25, we would call it kind of a lost earnings growth year because the first year kind of earnings growth was meaningfully cut. And even if the rebound in the second half, the full year growth rate might not look particularly great. In FY26, I would expect the growth rates to be somewhere in the range of 12 to 15%, which is back to its normal trajectory. And the reasons why that would be the same is because gradually as government decision making kind of starts to pick up, because now the distraction of local state elections are not there in the near term, and the national elections kind of has led to the same government back in power. I think particularly government capex-led areas would actually finally see the light of the day a little bit in second half of this year, but more so in FY26. So clearly capex and manufacturing is one area where I think momentum has kind of slowed down, but I think over the next 6-12 months, it is expected to pick up. The second area that I would think that would actually stand to benefit would actually be IT. I think courtesy the health of US corporates driven by the policies of the Trump and policy announcements of the Trump, as we get to the middle of this year, next year, you would see the IT companies actually starting to see better client budgets, and hopefully they should see better earnings going forward. The third area that I would point to is real estate, particularly because the stocks have been down over the last 6-9 months as indexation benefit was taken away. I think over the next 12 to 18 months, to whatever shape and form interest rate cuts happen, I think real estate companies will actually stand to benefit overall from this, particularly the ancillary names, ancillary sectors related to real estate that would do quite well. And finally, consumption. Two parts to consumption, the premium end and the rural part of the economy linked consumption names are the two segments within consumption, particularly on the discretionary side, where I would expect things to do better from where we are over the next 12 months.
So capex, manufacturing, IT, real estate, consumption, all of these look good, and hopefully in the next 12 months we'll see a recovery across the board. But then Trideep, which are the areas you would recommend trimming profits from? You didn't name financials, for instance. That has been a bit of a consensus buy. Auto again has been something that street thinks has peaked. Which are the areas that you are, let's say, taking money off the table or trimming your positions?
Yeah, so I think we've taken a bit of money out of the portfolios from particularly stocks which are exposed to urban consumption. I think there the headwinds are likely to continue a bit longer, i.e. in the next 6-9 months, so to speak. Second, some parts of this urban consumption is also subject to disruption driven by quick commerce, and I think they will also see a bit of impact of the same. The second area where we are not that sanguine would be the PSU financials, where I think it has done quite well over the last year or 2 years. We have certainly taken some money off the table in those areas. Third, also in banks versus NBFCs. We have taken some money off the table now that the stocks have rallied a little bit over the last 3 months or so. So broadly speaking, these are the areas where we have taken money out and put it to the areas that I highlighted.
Right. You are quite bullish that there would be a pickup in capital expenditure by the government in the second half and in FY26 as well. And you're bullish on capital goods stocks as well. But you don't own any cement names as such much in your portfolio. Any specific names for not going overweight on cement, given that they are also a direct beneficiary of the pickup in capital expenditure?
Good spot. So I think you're right in saying that while we have been positive on capex, we haven't really kind of shown that conviction in cement names, but that is because of an industry-specific event that is kind of happening in the sector, which with one of the new players being more aggressive in terms of expanding capacity. A lot of larger players are gradually kind of gobbling up the smaller ones. And whenever there is such industry disruption that stands to happen, usually what we have seen is companies tend to be a little more price aggressive. And that's what we've been seeing in two subsegments, cement and also in paints. When that stabilizes, the true kind of positivity of the capex-led growth would actually stand to come by. But till that time, we would let this sort of an event of industry consolidation play out before we turn positive on the name. We would be neutral, basically, the sector.
Okay, point taken. Thanks, Trideep, for making time and speaking with us. That's the latest coming in as far as market mood is concerned.
If you like this video, then like, share and subscribe to ET Now.